Hello and welcome to a special webinar from Fat Profits. My name is Roger Malik. I'm the Head of Client Services in our Sydney head office. Thank you for your company today, and we will be updating you with the new financial year that has just kicked in, and this is an important market update, and we will also be sharing some insights on how people are thinking where the markets are going. There is a lot of talk on recession, both in the US and potentially in Australia. And there's a lot of conversation around interest rates, inflation, and the reporting season in Australia that's coming up. So there's a lot to talk about. So hopefully you'll walk away from this webinar today with plenty of insights on how Fat Profit sees the markets. And we'll also be sharing some stock information, giving you a few stock ideas on what to look for currently in the market. So thank you for your company. We appreciate that. Joining me today in this webinar is our Senior Account Manager, Edward Allen. Edward, welcome to the webinar. New financial year, welcome, and I hope you're feeling well.
Hello, Roger. Great to be here again. We've just had a very busy end of financial year, as you know, and we're looking forward to presenting hopefully some new investors into our family here at Fat Profits and showing them how we've navigated the last 3 months. It's been a very deep correction, and we'll touch on that very shortly.
Excellent, thank you. All right, before we get into lots of topics to discuss, just the usual housekeeping. All our presentations from Fat Profits are general in nature. We don't provide any personal advice. If you're looking for that, please see your financial advisor or planner. And also past performance is no indicator of future performance. Now, during today's webinar, because this is mainly designed for non-members and for you to get a feel of Fat Profits' view on the market, as well as our service and what we look for, we encourage you to ask questions if you're not sure, and there is a Q&A at the end of the webinar. So if you do have questions about what we've discussed or our service, you can type them in on your screen where you see the orange arrow, and we should be able to answer them towards the end of the session. Now, before we get into some stocks today and give you some buys, sells, and holds and avoids, it's important to talk about the market first, because the market direction really dictates where your portfolio is heading. And we all have taken a bit of a hit in the last 3 to 6 months, probably the last 3 months in particular. And because the first half of the financial year has finished, we need to now look at how the last 6 months and how the last 12 months have been, and then also talk about where we see the markets going. And of course, there is a divide, amongst the analysts at the moment as to whether we'll see a reversal of the trend or we'll see a continuation of the downtrend and a recession is looming large. So here's the first update for you. The first half of 2022, we've seen the global markets all in the red, some more than the others. Of course, NASDAQ and the US markets at the right at the bottom are now officially in bear territory. And what that means is 20% drop or more is classified as a bear market. So the US indexes, including S&P 500, as well as NASDAQ, they're both in bear territory. When you look at the ASX, we are in correction mode. So anything past 10% is in correction mode, and we're down about 13% in the first half. The only exception amongst the major indices is FTSE, which is the London Stock Exchange. They're only down 3.5%, which is quite remarkable. So that's first thing first, looking at the rear view mirror. Then if you look at this in a bit of a chart format, you can see the top green line where the mouse is currently pointing towards. That's the ASX 200, which has stood out better than the blue line, which is the Euro Stock Exchange, followed by the red line, which is the US S&P 500. And of course, then you've got the green line at the bottom, which is the US NASDAQ, which have suffered the most. So that's a bit of a visual for you. Now, if you look at the first half of this year, as you may or may not have seen this, but this is the worst start to the stock market in over 5 decades. And you know, while there's two ways to look at it, one way to look at it could be, gee, this is all doom and gloom and there could be worse to come. On the flip side, you may look at this to see as an opportunity that surely this probably is a bit overdone, and maybe there are some buying opportunities for me to put that cash to work, and we'll discuss that in a moment. And here's a look at the ASX 6th worst month in 30 years. And right at the bottom, you can see June 2022, which we just finished, was the 6th worst month in 30 years, 8.9% drop. So certainly everyone's feeling it. Prior to that, the worst one we saw was March 2020. And then there's a few others, especially around 2008 when we saw the GFC taking shape. Now, if you look at the reasons for the sell-off, you can look at the financial year 21-22. Some of the reasons include, of course, high inflation in US, a larger than expected rate hike by Reserve Bank in Australia. And of course, we see a 75 basis points rate hike in US as well, which is the biggest one in almost 30 years. And now, of course, fears of a slowdown and a potential recession in the US. So having a look at some of the key events which have shaped our financial year, this is a good snapshot of what happened from July last year to June this year. And maybe I might get Ed to help me out a little bit here. Ed, lots have happened over the last 12 months. I mean, we saw right at the start of July, August last year, our market had hit a record high of 7,600 points. But since then, a lot of things have happened, including iron ore slumps and then so on. Maybe you can walk us through some of the recent market activity.
Absolutely. There's been a ripple effect there, and you can clearly see that chart. It looks like a bit of a heart monitor that's kept the economy alive. But yeah, iron ore, obviously China hit with COVID and restrictions, lockdowns in particular in Shanghai, and that's a continuing it's a continuing process at the moment. It seems to be shifting from city to city, so that affects our mining industry. So iron ore slumps on China restrictions, including the Olympics there. We had a bit of an issue there as well. And then you move on, US inflation lifts at the fastest rate since 1982. We know the effects of that, where interest rate hikes are now the norm, and the expectations is that they will go higher. Obviously, we've got a Russian and Ukraine war, well, Russia that inflicted on Ukraine, that's unfortunately affected the world as a whole. And I don't think Russia thought the world would react the way they did, and they have. Therefore, it's become a global issue now, not so much a centralized local issue between Russia and Ukraine. It's affecting oil supplies, wheat supplies, and so forth. So there's a ripple effect there. Then you've got the, just moving on that, let's go to here in Australia. The RBA in May this year was the first rate hike in 11.5 years. That was significant for our market. And then we've got a global interest rate surge, and then obviously in the US there's a fears of a US recession, but it's not, the consensus is it's not going to happen straight away. It may not hit the US until 2023, but the sentiment and the pessimism is there right now. So yes, there is some fear there, but we focus on fundamentals, and the fact is that most of the Western world is out of lockdown. It takes time for people to adjust their way of spending. For instance, consumer confidence here in Australia for June was up 3.7%, and that doesn't mean pessimism hasn't kicked in. It definitely has, and people are starting to look at the ways they spend, and that's something we'll keep touching on as time goes by.
Yep, thank you, Ed. So yeah, it's been quite an interesting 12-month journey. We've hit 7,600 3 times, but lately, yeah, since May, June, we've seen the big drop, and now that we're seeing some sentiment changes. However, let's have a look at the wrap up of the financial markets over 21-22. And this is quite interesting because it'll show you what parts of our market have gone up and what parts have gone down. So I'll summarize this in a quick way. So the ASX 200 was down 10% over the year, the financial year that is, 10% drop. You look at the US markets, also seeing a 10 to 11% drop in that same time period. Then you look at the currencies. Australian dollars certainly come down. It used to be 75 cents June 30 last year. It's 68 cents now, so drop around 8.5%. Whereas, of course, if you look at the interest rates, they've gone up. But the things which have been affected, certainly commodities, as Ed mentioned earlier as well, iron ore has dropped from crazy levels last year, $218 a ton, down to now more realistic, more sort of real number, about 130. So down around 40%. So that impacts certainly the mining sector. But coal, and which we'll talk about in a moment, coal has taken a huge, I suppose, run, and it's gone up 186% over this period. Oil is another one which has gone up. You look at soft commodities, they've certainly gone up on the back of the Russia war, the wheat and other soft commodities, they've gone up, beef, etc. What's been down is government bonds. They've been smashed. Property's still been up over the course of the year. So you see a whole range. And finally, the US dollar, which has also been up. So while a few things are down, a few things are up. So the key thing is assessing all that and now seeing, okay, where are we going to see the movement in the next 12 months? Are we expecting a continuation of energy and oil to go higher? And we'll touch on that in a moment. What about soft commodities? Are we expecting them to continue to run high with inflation? And what about the markets? So if you look at the markets first, let's look at the sector's performance for this year. And this might be a bit harder for you to read, but certainly the best sectors have been utilities, followed by energy. Those two really stood out. And then you've got some industrials, which have also been in the green. The worst ones have certainly been the small caps. They've been punished. Properties come under pressure in the last few months. And then you've got IT and tech stocks. They've been taking the brunt of the sell-off. And just to make it easier for you to read, here's the top 5 sectors: utilities, energy, and industrials. Materials have been okay up until the last 2 months. And then here's the worst 5 sectors. So the big ones which have taken a hit in the last 6 months in particular has been real estate and IT stocks. And we're still recommending to avoid that space going forward. And finally, just looking at the best stocks and the worst stocks in the financial year, well, no surprises there. You've got lithium and you've got coal dominating the top 5. So the AVZ, Core Lithium, that's obviously lithium stocks. And then you've got Whitehaven Coal, which is one of our recommendations as well. And then you've got others amongst the top 5. If you've got any of those, well done to you. And hopefully you don't have any of these stocks. If you do, look away now because they've been smashed. Magellan being the big name, and they've been suffering a fair bit. PointsBet, another one, and Zipco, which we've been avoiding, down 94% in a year. That's unheard of. And these are stocks we've been absolutely avoiding for some time. Now, Ed, looking at the CBA forecast, they came out just a couple of days ago and said they're expecting the Australian share market to go up by 7 to 9% in this upcoming financial year. However, the global forecast that they've come out with for the world is dropping to 2.2% next year growth. US in particular dropping to around 0.4%, but China lifting back because they've been slowing down over the last few months, but China lifting back, and that's got to be a good thing for the world as well as Australia. What are your thoughts?
Yeah, we are predicting that our zone, the Asian zone, will outperform world markets. We're in a far more superior position. So we're going to come out of this much better than the rest of the world, in particular US, where recession fears are going to be very clear for the next 12 months. But due to our population here in Australia and also our mining industry in particular, and also the fact that our property market has surged in the last 2 years gives us about a 20% buffer to the rest of the world. So the US has that buffer as well in their property market as well, but that's a key indicator. So yes, we expect to outperform those numbers over the next 6 to 12 months.
Excellent. Well, and just to clarify also, at Fat Profits, we think that the US recession is not a story for the next 6 months or next 12 months. We think it's more like end of 2023 is when we're expecting a drop in the US economy and the GDP. So up until then, we're still going to be in the market. And if you're sitting on cash, we will be suggesting to you that you should put that cash to some work, and we'll give you some ideas today. So stay tuned. And one of the reasons, of course, is unemployment in Australia has currently hit 48-year lows, and we're just below 4%. And a full economy is certainly a good thing, but also looking at the ASX sector weightings, this gives you quite a good indication. And a few sectors that we're avoiding out of this is certainly real estate. Although we're not completely avoiding it, but it's something to keep an eye on. Maybe there's 1 or 2 stocks within that space we're holding up all right, and we're happy to hold them. IT, one thing we're certainly avoiding. Energy, happy to hold. Telcos are fine. You got financials and materials, and that's where the real focus is for us, is we see these 2 sectors outperforming over the coming 12 months, and we'll explain to you in a moment. But Ed, if you look at the ASX 200 chart, you can see there's a big support line where you see the orange line there. That's around that 6,400 points. So we've just bounced off that. Plenty of support there. What's our thoughts in the next 12 months? Are we following or agreeing with CBA 7 to 9% increase in the Aussie share market?
Yeah, absolutely. Our reporting season will confirm that the companies that we cover in particular are very solid. And we've had quite a number, in particular in our income portfolio, that have actually outperformed the market in the last 3 months. So it's not all doom and gloom, and we believe that the reporting season will confirm that most Australian companies, in particular the top 50, the top 100, are going to be going into the next 6 months very strong, and that will cause a bit of a rally post-August in our market there.
Yep, excellent. All right, so next month's reporting season is something to absolutely keep a keen eye on. Look, one strategy which we certainly don't suggest, I think a lot of us have been following this strategy for the last few months in particular, is what this guy is doing, standing there and praying. It's called the old BHP strategy. If you haven't heard of it, you might have a laugh, but it's called buy, hold, and pray strategy. So currently we're all doing that to some of our stocks. And praying that they come around. Unfortunately, it doesn't always work, because if that's how things work, then of course we'll all be billionaires by now. One strategy which we do suggest is dollar cost averaging, and that's a strategy where you're buying equities at periodical intervals, regardless of the market being up or down, and you buy them, say for argument's sake, so on a monthly basis, or every few weeks. It's up to individuals, but regardless of the market direction, you continue to buy those quality stocks which are fundamentally strong, you well-researched companies, and you see them, you see yourself holding those stocks for the next 3 to 5 years at the very least. So that's one strategy in volatile markets. Works like a charm. We've been suggesting that. So let's talk about the first sector now that we've done the macro. The first sector which has been in focus is financial sector, and this is a longer term chart of how it's looking, but maybe I'll show you another chart where you can clearly see this is even longer, probably over the last 20-year chart, and you can clearly see the 2 big drops we've seen, first in GFC in 2008, where we saw a huge drop in the financial sector, and then we saw in COVID 2020, not as big, probably half the size of the previous drop, was still significant. Now we're seeing a bit more of a consolidation. The financial sector has dropped around 15% from its recent highs, What's our thoughts there on the big financial companies in Australia?
Yeah, Roger, we have a buffer. You know, our banks, you know, they've all hit their tier requirements many years ago, and also we have the biggest part of any of our banks' business is the mortgage market, obviously, and we do have a buffer there. We had a boom in our housing market over the last couple of years, and there is about a 20% buffer there. So, and the other reason is that we have self-managed super funds here in Australia, and most self-guided investors hold the banks in their super funds, and they don't sell them. They just hold them long-term, collect the dividends, well supported. Now, the banks do obviously invest in the financial markets, so they have copped a bit of a hit in the last 3 months. But again, their investments are risk averse. It's generally the top end. They also get income from the market, which is usually 5 times what they pay for their term deposit distributions. So that's how banks make their money: mortgages and income from the financial bond markets in particular as well. So they're very safe as far as we're concerned here in Australia, unlike the US and other countries. And we believe the banks will turn around in the second half of the year. We'll show you some charts shortly.
Excellent. All right. So we do think they've come out of COVID in actually much better shape than some of the global banks, and that's something to keep an eye on. Here's a report that we just published for our paid members, and we'll just show you some snippets out of this report. So if you look at the big 4 banks, and you can see the share prices, but the key thing is the dividends that we're expecting next year, and the net interest margins, which is the NIM figure. Now, out of those big 4 banks, CBA's got the best net interest margin, followed by Westpac, and then the other 2. But that's just one criteria to look at. Then you look at the dividend yield. CBA's got the lowest, followed, you know, then the highest is ANZ and Westpac. But the capital strength ratio, you look at that, obviously NAB really stands out. You look at the deposits and mixed loans. So while this is just one of the indicators, but there's more to the banks than just that. Having said that, we don't buy and support all the banks. So for example, there's one bank, which is Westpac, we are buying at the moment. But there's one out of these banks we are not buying as well, which we don't like. And we're happy to share that with you now, CBA. We don't find the CBA valuation attractive at these levels. A lower dividend yield, high premium, but Westpac at the moment, if you were to look at currently, stands out better. And this chart confirms that, because if you look at, firstly, just the dividend yield out of the big 4 banks, Westpac is quite high. It's around 9.5% gross yield, fully franked, including franking credits, but also the price to earnings ratio is quite good compared to the others. But we've also thrown in a couple of insurance companies, including QBE and Suncorp, which you may also look at. And you know, the details of this report, we publish that for our members, is for them to make an easy decision as to which banks are the better ones and which ones are the ones to avoid. So certainly we like the sector overall, but not all of them. Let's talk about Westpac, Ed. I mean, there's multiple reasons to like them at this stage, because they do look undervalued. The consensus in the market seems to believe that they should be valued somewhere between $26 to $30 today. They are just shy of $20 right now. What are your thoughts on Westpac?
Yeah, it's undervalued compared to its peers. So as value investors, which is what fat profits do, we pick the value out of the market. And we believe this is the best value bank stock in our portfolio right now. That's why we're sharing it with you today, purely based on fundamentals. So there's a snapshot there on the screen. We won't go through it in detail, but we do have a full research report on our website, as well as that financial services report that we published a few weeks ago to our members. So, and since then, these stocks have moved in the right direction, but yeah, they've got a lower net interest margin compared to its peers. Its return on equity, it's coming from a lower base, so, and that obviously impacts the amount of dividends that they're paying compared to their peers. You know, almost double the Commonwealth Bank. So on percentage, well, obviously, if you bought Commonwealth Bank 40 years ago at the float, it's a different kettle of fish. But if you bought it in the last 6 to 12 months, you're obviously down on your entry level. You know, there are people that are paid well above $110 per share in the last 12 months for CBA. So on those metrics, based on core earnings and return on equity, and also your return as an investor, which is your income, your dividends, this is the best value at the moment. We're happy to share that with you today.
All right. Thank you, Ed. And the chart also shows you, and of course, when you're buying stocks, we always want to buy low and sell high, and that's the goal. And that's one of the reasons why Westpac today is certainly one of the undervalued opportunities for you to consider. Now, let's have a look at our income portfolio. Now, Ed, this is probably one of the most talked about parts of our service. Is we publish a model portfolio for dividend stocks, and we call that income portfolio. That currently has 21 companies. They are in the top 200 in the ASX, of course. And this portfolio over the last 10 years has been producing annual returns, which are unheard of, is 17 point, you can see that right at the bottom right, 17.1%. Now this 17.1% is a combination of capital growth as well as dividend yield. So we combine all that together, which you can see here, the capital return per stock, the income return per stock, and then the total return per stock, which is basically you add them together, and then an annualized return based on when you bought them till today. So an annualized return of 17.1%. Look, Ed, for those people who are watching this right now, I bet that there is probably majority of those people who are getting less than 17% a year. And that's probably part of the reason they're looking at our Fat Profits webinar today, to look for an opportunity to see if they can do better. What's your advice for those people who are watching this and looking at this real numbers over the last 10 years? What's your advice to them?
Yeah, these are actual returns. You know, I know a number of members that I look after for a very long period of time. We published this portfolio shortly after I joined Fat Profits back in 2011. And we're able to present our members with a model portfolio. It started with about 12 stocks. It currently has a composition of 22 stocks. So it's almost doubled in composition over that period. But in your self-managed super fund, there are literally, I could probably say 100 members plus that I've spoken to, probably more over that period of time, that have got the larger funds that are able to buy all 22 stocks. And spread the investment evenly across those 22, and you will get these same returns. And these are generally defensive stocks, spread across financials, industrials, and property REITs, which have delivered these returns. So you hold the stock for a full 12 months, and that's the average return, 17, just over 17. It was just over 18% before the last correction.
Yeah.
So it's only gone down an average of 1% in the last quarter during this current correction. We just updated that portfolio recently. So as a member, you can go into our Australian equities portfolio. It's part of the Australian equities portfolio. You can have access to this information pretty much today.
Yeah, excellent. Thank you for sharing that. And just to show you a bit more of a snapshot of how this looks like, and maybe a bit better visual as well, this is how the dividend forecast looks like for the next 12 months. So on the left, you see the financials, and we're hiding some of the stocks, of course. We're not going to share that all today, but we're happy to share a few stocks, for example, Amcor, BHP, and BWP Trust. And then we'll talk about Amcor in a moment. But you look at the dividends per share for financial year 22, financial year 23, and then you look at the net yield per stock, and then you've got the gross yield per stock for financial year 22 and 23. And on the right-hand side, you can see which ones are fully franked, 100% or not. So some stocks, of course, outperforming the others in terms of dividend yield return. You can see there's two there which are in double digits for the next financial year, 12% and 10%. Then there's a few which are close to 8-9% as well. So the portfolio average return in terms of dividends is forecasted to produce 6.6% gross yield in the next 12 months. So here's the question for you. If you can structure a portfolio like ours without needing a fund manager to do it for you, and you can do it yourself by paying a very small fee to us, and we can help you manage this portfolio yourself, and you could get 6.5% dividend yields from this, as well as get another 10% of growth. So all up, get around 17% a year. Are you open to doing something like this? Would you be willing to take an opportunity and join Fat Profits if we can help you with this? Especially if your portfolio has taken a hit in the last few months. And the reason you're sitting here watching this today is to get an edge and do something better. Now, I've just received a question from Margaret. She's saying, hi guys, I have a fair amount of cash from a recent property sale. Now, if I was to construct an income portfolio following this model portfolio you have, how would I give the weighting per stock? Is it based on equal weighting per stock, or do you also tell us what percentage allocation per stock? Ed?
No, so we don't give you direct advice. This portfolio is equal weighting. So you would spread it evenly across 22 companies. And the reason, I'll be honest, the reason members have stayed with us over a long period of time is that you get this all as part of your subscription cost. So if you were to have this professionally managed, it would cost you somewhere between, depending on the balance, 1% and 2% per year. So let's say on $100,000, it will cost you $2,000 in fees to have it professionally managed for you. So as a self-guided investor, Margaret, all you need to do is join and we'll give you this information. You go buy those stocks evenly yourself and manage it in your own super fund or personal portfolio.
Great. Thank you for that explanation. And Margaret, just so you know, we update this portfolio on a quarterly basis, so not a monthly basis, because you don't need to make too many changes, but every quarter you'll get a full detailed report and some action plans on what to do. All right, thank you. Moving on to who's Fat Profits. So most of you watching this webinar, because you're not members, you may have seen us around, but in case you haven't, Fat Profits is a stock market research firm. We're based in Sydney, where we've got our head office. We also have offices in London and Auckland. And this is a picture of our CEO, Angus Geddes. Angus opened the company back in 2000. So we've been around for 22 years. And Angus is also a fund manager. And he manages up to $1 billion in listed and unlisted funds in the Australian market and also international markets. So what do we do and how can we help you? Well, we don't manage your money. We're not stockbrokers. We provide you the research, and you can take that research to manage your own money. So we're almost like your 24/7 caddy, if you like, if you're a golfer, and we will do the work for you. However, you will buy and sell yourself. Now, what markets do we cover? We cover Australia, Asia, US, UK, Europe, and also emerging markets. So if you're looking for commodities, Australian market, international markets, we've got coverage for pretty much everything. Now, Ed, you've been around for a long time with the company, 11 years. Maybe you can add anything I may have missed, and also we can look at...
Pretty simple, yeah. We're value investors. We invest in value stocks, and we're not stockbrokers. So our members do their own buying and selling. Our members are typically self-guided investors, either new to the market, green, the first step into the markets, so they need to educate themselves. So they use the service for educational purposes and understand the markets first before they invest. We do all the legwork. All they need to do is follow it. We have our preferred portfolio in each report on the website, and then obviously then we have our self-funded retirees, which is probably, I dare say probably 60 to 70% of our membership base are all managing their own self-managed super fund or family trusts or personal portfolios or both. And over the period that I've been here, I've noticed a lot of members maybe had fixed super, industry super funds, started off with a personal portfolio, improved their confidence in the markets, educated themselves, and now manage all of their investments. So they have multiple portfolios. That's the advantage of being a member, is that you educate yourself in the beginning, which will allow you to do more and take on more risk in managing your own money.
Yep, absolutely. And here's a picture of David Lennox, our mining analyst, and he's also a geologist, and a lot of our team are usually on TV channels like Sky News, Business News, Bloomberg, and AusBiz. He's also been a fund manager before with Colonial. And it's a funny story. I might even just share that very quickly. David's close to, and I'm sure he won't mind me telling him, but he's in his mid-60s. And just a few months ago, there was an 85-year-old gentleman who was watching a webinar, just like you guys are watching it today. His name is Jim, out of Melbourne. So he watched the webinar, and I actually called him after the webinar, and he said, I used to work with David back in Colonial. And he was obviously senior to David because 20 years older than him. And he said, I still remember David, and I want to join Fat Profits because I believe in David and his commodities recommendations in particular. So he actually joined us for 2 years at 85 years of age, and he said, make sure you say hello to David. And I went back and told Dave, I said, Dave, do you remember Jim from Colonial days? And he goes, yeah, Jim actually burnt the office down. He actually put the microwave or something on fire. And he said, yeah, I still remember Jim. But yeah, a bit of funny story from the recent past. But yeah, David's very experienced. A lot of people like him, and he's very good for mining recommendations. And finally, look, we also, as we mentioned, Angus, our CEO, is also a fund manager. So this chart shows you our Australian portfolio where Angus manages real money. And the orange line is his portfolio, this Fat Profits Australian portfolio. And the black line is the ASX 200. So we've nearly tripled the ASX 200 since inception back in 2007. And that's been a phenomenal outcome of real money, real returns for our investors who've parked their money with Angus and his team. So this is just to give you a bit more confidence that we are, putting our money where our mouth is. Now let's talk about the next sector other than financial. Let's look at commodities now, Ed, because commodities have been one thing which has been in big focus over the last few months in particular. But before that, let's look at currencies. So Australian dollar, it's actually been down over the last 12 months, and more so since the war broke out earlier in March. And we've seen the US dollar rise in comparison. And here's a chart of the USD from last year, July till now. It has been an absolute phenomenal run against market expectations. And US dollar really impacts commodities, doesn't it? So if you look at hard commodities, you look at everything from gold down to iron ore and steel and lithium, everything's affected by the US dollar. And let's have a look at the commodity index now. The commodity index for Australian commodities has generally been up, has seen two big runs and then a bit of a cooling off period, but long term has been a sustained uptrend, which is quite good. We expect this trend to continue over the next 12 months as well. Iron ore, we talked about earlier, started off at around $200, went down to around 80, and now sort of at manageable levels around 130. And finally, looking at the last two, coal had as a huge run. We saw two of the best 5 stocks in the ASX in coal, and that is expected to continue. So if you missed out completely in anything in coal, well, you still have a chance, because we expect this price to continue to go higher. And the last one is oil. And Ed, some JP Morgan came out recently. They're saying worst case scenario, they're expecting US crude oil to not be 120 right now. They're expecting in the next 12 months, this could be as high as $380 a barrel. I could not believe when I read that report, and I'm sure it's a bit exaggerated, but what they're saying is, that there is more to come. What are your thoughts there on commodities in general?
The demand is definitely there. At the moment, we've got a European summer, so the demand is not going to be as high, but once it flips over in a few months' time into autumn, the demand's going to outstrip supply. So, and obviously there's the restrictions on Russian oil, and also you've got Iran weighing in recently as well. So that space is still playing out. It's definitely not over. At the moment, we're enjoying our best returns are our oil and gas stocks, Rog, in our portfolio, and also the coal stocks that we cover.
Coal stocks as well, yeah.
And there is going to be a turnaround in some of the. See, the thing is, our market here in Australia, especially the materials sector, which is a big chunk of our economy, is supported by the low Australian dollar, even though we've had back-to-back interest rate rises, and we'll get more. The Australian dollar's remained below 70 cents, and also on the flip side, commodity prices are close to record highs. So that's the support for the sector. So even though the sector in the short term dropped because of COVID fears and what's happening in China and demand fears, it's going to be the bulk of our turnaround over the next 6 to 12 months. So definitely watch your space.
All right, let's have a look at one commodity we can talk about today. Something you may or may not have looked at is the gold sector. Now, gold historically has been a good hedge against inflation. It's also been a safe haven, and that appeal is usually what drives investors to gold in choppy times. If you look at this longer term chart, you can see gold has generally been up. The last probably 3 months or so, it's been, it's come down from its recent highs of $2,000 down to around $1,800, $1,850 at the moment. Now, if you look at the Australian dollar gold price on the other hand, because the Aussie dollar has come down, the Aussie dollar gold price has actually gone up. So tell us, Ed, why is this important for our Australian gold producers? Because we have a number of companies. We're about to talk about one of them in a moment. But what are our views on the gold price?
Look, the gold price has performed well. The problem is gold stocks haven't. They've gone the other way. And that's for a number of factors due to COVID, labor-related issues, weather, operational issues. Some gold miners are actually expanding, and some are, pulling into the sheds and just focusing on exploration during these times. So each company is fundamentally different. Some are far more superior. We'll touch on that with a number of stocks shortly. But yeah, as far as the gold price goes, it's performed exceptionally well. There's no issues there. The problem is gold stocks have gone the other way.
All right, let's look at one of the stocks now, because if you are looking for an opportunity, you always want to buy when things are lower. And one of the stocks, which is the second largest gold producer in Australia, is a company called Northern Star. And they, about a year ago, merged with a company called Saracen Minerals. So now combined together, they've become a bigger force. And we've got a buy recommendation on this stock. And this is certainly looking quite cheap at the moment. But all in all, the operations are very good shape. Financially, they're in very healthy shape. And this image shows their pathway to annual production of an increased amount of 2 million ounces of gold in the next 4 years. By 2026, they're expecting to ramp this up. Now, if gold price remains reasonably strong, we can expect this stock to rebound, Ed. Currently, this stock is down from its 2021 highs of $17, and it's now down to around $7 a share, which is actually quite a big drop. What are your thoughts there, and can we expect this company in the coming couple of years to get back up to that $17?
Well, that's what we're predicting, is that ramp up. So this is one company that's expanding, and that's why we put a buy on this stock today for our investors that are watching this webinar, because this stock has underperformed. Just look at that chart. It's almost half, well, more than half off its peak, and that was only about a year and a half ago. So This is a company that's expanding. We believe they'll control their labour shortages due to COVID. The government should start signing off visas very shortly and improve that labour market. And weather, look, it's going to have weather. There's going to be ongoing weather issues as we've experienced over the last couple of years. But this company is a buy because it is expanding, unlike other producers and its peers, which have actually reined in production and focusing more on exploration just to reduce their costs in the short term.
Okay, excellent. And keeping in mind dollar cost averaging, that's something we've focused on before, and you can see we bought a number of times recently, and that's the way to go about it, is dollar cost average, buy it a few times. Now, before we look at a few more buy recommendations in a moment, let's also look at stocks to avoid in today's market. Now, this next image, which shows you the retail environment, the inventory levels in the US market. And what that simply means is if you look at the green line, that's the wholesale inventory levels. And the purple line is the retail inventory levels. And you can see since COVID happened in 2020, the inventory levels have gone up crazy. And that simply means is that a lot of these companies are stocking up, expecting demand to continue at the same pace. However, that's not happening anymore. And as inflation is eating away at the consumer's hip pocket and rising interest rates are impacting everything we're spending, these inventory levels are now coming under pressure. So the retail companies are going to have to discount even further, or some of them are even dropping their prices crazy, but this is in the US. In Australia, there's also a similar story. If you look at one of the stocks here, and there's a number of them on the market, but one of them is Kogan, the online retailer, and they've had similar issues operationally as well as with the inventory levels, and they've made that announcement to the market a number of times in the recent months that they're struggling with inventory levels. And look at the share price, where it's heading from $24 last year down to under $3. Absolutely smashed. So we're avoiding that stock. We have been avoiding for quite some time, and this is not a recommendation to buy, even though it might look cheap on the chart, but there are operational issues. Next stock is Wesfarmers. We're not saying in the same boat as Kogan. They're a better organization, better managed. However, they've also come under a reasonable amount of pressure of late. And we've said that about 2 or 3 months ago in these webinars to non-members, avoid Wesfarmers when it was sort of around $55 a share. Now it's come around $40 a share, and we're still avoiding that at the moment. We still think the peak is behind this company, and for the short term, we see a bit more pain before we see some updates from this company. Next one is Zip. So maybe Ed, you can talk about this one.
Yeah, look, it's in that e-commerce buy now, pay later space, which has been smashed in the US. It's look, obviously carries some high levels of debt. There's a merger there with Sezzle. Look, it just hasn't played out, and it's absolutely been smashed. Now, potentially a debt cap bounce and a turnaround story in the future for the faint-hearted. But if it's money you can't afford to lose, I would avoid this stock. That there will be speculators saying that this stock will probably have a bit of a debt cap bounce at some point. It has been severely oversold, like the entire sector. But as value investors, we hold stocks anywhere between 1 and 5 years. So we're not in those stocks for 1 year where they have a chart going from $4 to 14. That's great for the day traders. I mean, if you can catch that, good luck and well done. But if you get caught at the top, and December last year was the peak for all of these e-commerce growth stocks, they all peaked in December last year. If you look at all the charts, they all look very, very similar. And some of these stocks are off 60, 70, 80, 90% off their December peak in just 6 months. Yes. So there's a lot of people coming to us from other services and who want to who need to turn their portfolios around very quickly. And I've had numerous conversations over the last month or two, in particular in the last couple of weeks, where I've seen some of these portfolios. We've actually sent them through as part of our platinum service. We do offer a portfolio review, and they've just followed these stocks religiously, and they've lost like 80% of their capital. And this is real. I'm not joking. I've seen a portfolio that started at 400,000 that is literally sitting at about 120,000, 80,000, 90,000. I've seen a few of them at the moment. And this is what happens when you take too much risk in growth stocks.
All right. Thank you, Ed. So yeah, this is one to avoid as well if you're thinking this is cheap. And the last one just for today is Magellan Financial Group. That's a stock we've held in the past, and you can see there we bought it at $1.74 in 2012, and we sold it at $25.82 in 2018. So over a 6-year period, that gave us a 1,600% return, which was annualized at 54%. But once we exited, we haven't come back to this company. Recently, they've had a lot of issues with money leaving the platform. One of the bigger investors have gone. They've had leadership changes. And look, until we see a turnaround, we are not interested. So a lot of people asked us at $20 that we should buy this back. We said no, and look at this now, it's down to $11, $12. We're still avoiding that, so that's something you should keep in mind. Here's a list of...
Yeah, sorry, Rog. Hamish Douglas recently sold $10 million worth of shares. I think there's an issue going on there in his personal life. So him and his wife own those shares together. So he sold 10 million, and the share price dropped another 10%. But he still has about 20 million shares in the company with his wife. So there's all sorts of issues there. So I thought I might just put that out there.
Yeah, sure, not a problem. Let's look at the sell recommendation. Now at Fat Profits, we not only tell you which ones to buy, which ones to hold, and which ones to avoid, which we've just gone through, but we also tell you when to sell. And here's a list of some of our sells we've done in the last few months. And you can see the names there starting from Domino's Pizza, our buy price, the sell price, the gains we've made, the annualized return, and a $10,000 investment, what that would look like once we sold that stock. And while you can see lots of green, we don't claim that we are perfect. We've got 3 of them in the red, so we have lost some money in between. But as long as you can get majority of your investments right, you can make a reasonable amount of money. And Whitehaven Coal is our recent sell. You can see it right at the bottom, which we'll talk about next. And that's given us quite a healthy return of 136%. But in between, look, we've sold Amcor, we've sold Domain, which is a property company, Sonic Healthcare, you might be holding that perhaps, or even Nine Entertainment. So there's quite a few sells that we also recommend from time to time based on market conditions. And let's talk about one of the stocks we've just sold half of is Whitehaven Coal. Now this is obviously quite a large company. They're well diversified, as you can see some of the operations and where the consumer base is. And these are some of the markets, so especially in Asia, including Japan, Korea, India, Malaysia, and Indonesia. So the Asian markets, that's where the big consumers are. And if you look at where they've been delivering into these markets, then you can see for thermal coal, Japan is the biggest customer, followed by Korea. For metallurgical coal, you've got India as the biggest seller or buyer, I should say, followed by Indonesia and Korea. Now, why they've been producing good numbers? Well, largely thanks to a rising coal price. And this is a quick look at their financial year first half highlights. And it was a record number all across board, including, of course, a high coal price, revenue, as well as cash flow as well. And they also announced a pretty solid dividend, which was a nice surprise to shareholders. All in all, this stock, we bought it at $2.08. We bought it a couple of more times along the way. And recently we just sold at $4.83, half of our holdings. So a 10,000 investment has given us $23,000 in return. This is over a period of 11 months. So just under 12 months and given us a pretty healthy return, even though the markets have been choppy, but this was the 3rd best performer last year. So quite healthy. And these are the type of stocks you want to be holding in a falling market. Next stock, Amcor. Maybe Ed, you can touch on Amcor just briefly.
Yeah, sure. It's obviously a packaging business and aerosol cans as well. It's actually outperformed the market in the last 3 months, Roger. It's been defensive. It's obviously got a bulk of its earnings from North America as well, so there is an advantage with the Aussie dollar at the moment. But it's one of our core holdings in our Fat Profits preferred portfolio for members, and the numbers you can clearly see it there. It's all in the positive, 237% growth over that period. Initial buy at $5.42 back in 2010. So it's been a long-term holding for us. But if you look at that chart in the short term, obviously it had a hit during COVID, 2020, and it has actually performed since, and it pays a very solid dividend as well. So we've got this as a hold at the moment. It's a bit overvalued. If you look at that chart in the short term, over the last 3 months, it's completely gone the other way in performance. Good stock.
Yeah, absolutely. All right, let's have a look at our performance now. Overall, how's Fat Profits portfolio going? And we obviously manage all our returns, and we publish all of this for the market. So these are our annualized returns since inception in 2000. So we've been averaging 17.8% annual returns over the last 22 years. And against the market, which has been producing 8.5% returns per year, that's an outperformance of 9.3%. So first thing first, this is where I think a lot of people who are watching this webinar usually go, okay, well, this sounds great. I'd love to get similar returns over that period of time myself. But of course, nothing is perfect. So we're not claiming that we get it right every single time. But here's a breakdown per year, and this will show you some real numbers. So for example, 2020, we got 20% returns. The market did 3.6%, so we outperformed the market quite easily. But 2019 was not a great year for us. The markets did 24%, we did 19%. So, you know, hypothetically speaking, we could have done better. So we underperformed the market by 4.5%. However, if you look at the other years, look, we've outperformed the markets. 2018, the markets were down, we were up. 2017, we doubled the market. 2016, we doubled the market. And 2015 was absolutely phenomenal. When the markets were down, we were up to the tune of 21.6% outperformance. So all in all, look, we do know what we're doing. We've got a fantastic team of people, and we get it right more often than not. So I suppose the one key question for you to ask yourself is, what are you willing to do to get similar results? Are you open-minded to try something different? Because if you are, we've got some good news for you in a moment. If you want to maintain what you're doing and keep doing the same thing over and over again, well, you will get the same results. So it's an opportunity here today for you watching this webinar. And this is a snapshot of what compounding results would look like. So if you were to maintain 17 to 18% annual returns for a long period of time, even if you invest small amounts of money, say $10,000, if you invested back in 2000 and you invested $5,000 per year over this 20-year period, that would turn into $1.6 million. So this is just to give you an analogy of compounding returns, how powerful that is over a long period of time. Now, Ed, we've had a number of reviews. People don't have to take our word for it. We have a lot of members who posted the reviews on an independent website, productreview.com.au, and we have 4.1 star rating. And a lot of these members have been with us for years. But I saw an interesting review last week or a couple of weeks ago from Doug. I thought that was quite a good compliment, if you like. He said that we are the best thing since sliced bread. That made us all laugh at Fat Profits.
Yeah, we really appreciate these reviews. I know I have Google reviews and also use product review on my Google Maps. It asks me to review places that I've visited and services that I've used. So I definitely put reviews up all the time. I think it's important for every business to get a reality check. But we've worked very hard, Roger, in the last 3 years, probably since 2019, in improving Fat Profits and improving our customer service in particular. We have customer service representatives on the main line now, so members get their questions answered. We're not just an online service where you just sign up online and that's it. You don't get to speak to anyone. You know, we have real people here, and these are real reviews. So we're very proud of those reviews. You can check them out on productreview.com. Excellent.
Now, I've just got a question from John, and while we look at some other reviews, there's a retired fund manager and a stockbroker. David, yes. He's actually quite a big advocate of our services, put a big long review. Penny, she's been with us for over 8-9 years, and she always appreciates everything we do, and she says every investor should look at what we offer. So we appreciate this. But we just received a question from John from Western Australia. So in fact, he's made a comment. He said, I'm an ex-member of yours. I stopped using the service about 12 months ago, and this webinar today is a good refresher for me because my portfolio has taken a severe hit in the last few months. And 12 months ago, I thought I can do it all myself, and my portfolio was doing quite well. However, now that I'm a bit lost, I'm keen to come back and get some advice. So the question that he's got for us, Ed, he's saying his previous package that he had with us included discussions with an account manager and a portfolio review as well. He's saying, do you have something similar that you can offer for me to rejoin the service? And I'd like somebody to look at my portfolio.
Sure. We did recently introduce the Platinum service. So we used to, in the past, do one-off portfolio reviews as part of a membership plan upon renewal. But now we do offer it as part of our Platinum service. So most people join Platinum not only to get all the reports, including the global equities and UK reports, but it's mainly for the portfolio reviews and the portfolio discussions. So we'll show you a bit more about that, John, and anyone else that's interested. And now's a good time. We've had a lot of requests for portfolio reviews throughout June, as you can imagine, and we're getting through those at the moment.
Yeah, absolutely. Well, 12 months ago, look, markets were different. And you're not alone, John, and we don't blame you for thinking that everything is hunky-dory and things will be fine on your own. Everyone thought that the markets were pretty easy back then, but things changed pretty quickly, and this is where some good advice will help. So here's a few reasons to join our service today. Firstly, of course, our performance, which has been built over 22 years, and that's a phenomenal outcome. Second is, of course, it saves you time on research. We have lots of experienced managers, fund managers, analysts who can help you, and they can do the research for you. We don't get all of our stocks right, but typically we get 7 out of 10 winners in our list. And the best part of our service, in my opinion, is we don't do any direct marketing or upselling and annoy our members with constant emails and phone calls to say, try this product, why don't you try product B and C and D and E? And there is many services like that, and you guys who are watching this, you probably already have tried them in the past. We don't do any of that. And finally, of course, we're not just journalists, we manage real money, and we've shown you where we've tripled the market returns with real money, with Angus leading the charge of our fund management. Now, we have 3 types of memberships for you to consider. The first one is standard, then we have premium and a platinum. So with standard, premium, and platinum, either one that you choose to go with, we will issue a tax invoice. So we can make that to your self-managed super fund or your personal name, and this could be a tax deduction for you. Now, how this works is very simple. In all 3 membership types, you will receive the first 3 features common across board. The first feature is you get a daily Fat Chat market commentary. That's via an email from Angus, our CEO. Every morning, Monday to Friday, you get 5 emails throughout the week about what's taking place in the markets. This is very informative and saves you a lot of time in reading what's taking place. Second, you get a weekly members-only webinar every Thursday at 12 p.m. for 1 hour. Now, if you can make it live, it's interactive. You can ask questions from our analyst, and we share with you what's going on in the market each week. And we discuss 15 to 20 stocks per week in that webinar to let you know which ones to buy, hold, sell, and avoid. So this is very informative. If you cannot watch it live, we will email you the recording, and you can play it at a later stage with your partner or your somebody else that you want to sit down with to discuss the market opportunities. Number 3, you get a Friday Fat Wrap, which is a wrap up of the week, any major highlights on a Friday night. And that might sum up for busy people any major events that you may have missed out on. So those first three benefits They are common across standard, premium, and platinum. The difference is with standard, you can pick 1 out of the 4 reports to be published. With premium, you can get 2 out of the 4 reports and an account manager. And platinum, you get all 4 reports and an account manager. So what are the reports? We got Australian equities first. That covers Australian market, as well as a little bit of New Zealand and Asia. So that's our flagship product. Nearly everyone we signs up with us, that's the first product they want, covers the Aussie market. Number 2, global mining. As the name suggests, global mining, but they're not all international mining companies. About 80% of the mining companies are Australian miners. So if you're interested in mining, commodity super cycle that we're currently in, that's a must for growth. Number 3 is global equities, which is of course international markets like US, Europe, and Asia. And number 4 is UK equities, of course, for the UK market. So if you are an Australian investor only, we suggest to look at the premium membership. You can choose the first 2, Australian equities and the mining. That'll give you a good combination of both. Plus, you will have an account manager, so you can call them and email them if you have questions, and they can answer them and help you make some investing decisions. If you want international markets as well, then best value would be platinum, where you get everything. This is our highest level, and that's what we would suggest. Now, just before we look at the pricing, I would like to show you our website just briefly for a few seconds, because on this website, when you log in, and you can see here we've logged in, you go to the members homepage, you scroll down, these are our 4 products. So you've got Australian equities, UK, global, and the mining. Okay, so let's quickly show you Australian equities. So you have a weekly report with 4 to 6 stocks per week that will come to you every Tuesday. You can see a table of all our latest new recommendations by clicking this here. You can see our model portfolio, Fat Profits, by clicking this. All our past recommendations, including the winners and losers, remember 7 out of 10 are winners, will be here. And we send you alerts midweek. So if there is any announcement on a stock that you need to know, we will email that to you straight away. That income dividend portfolio that we looked at earlier in the webinar, remember, that was converting 17.1% a year for the last 10 years in the market with 22 stocks. That's right here. So you will click that and it will take you to that portfolio, and you can copy that portfolio if you wish. And Margaret, I think that was your question earlier. And finally, all our webinars are recorded and they are placed here along the bottom. So you can replay all of these webinars by clicking, and they're all listed with dates available for you. So that's how the website looks like. Now let's look at the pricing. Before we look at the pricing, I'll just show you our pricing on the website. So it's not very a secret. On our public page, you can go to products and you can check out our pricing structure. So if you want to be a standard member, the retail price is $1095 for a year, and 2 years is slightly cheaper. Premium is $1545 for a year, and then if you go for 2 years, it's a bit cheaper. And platinum is $25.90 for a year, and of course 2 years becomes a little better in value. So these are pretty nominal prices. Most people are pretty comfortable with that, and we give you a tax invoice for that as well. Now, having said that, let's look at some special prices. Ed, over to you to explain these special offers.
Sure, and just before I do that, we do have 2 more hidden gems, Roger, to go through. We're going to give away 2 stocks that are very attractive at the moment, and we'll show you why, and that'll come after this poll. And our hidden gems so far in the last 12 months, Roger, every single one has gone up and stayed up. So members joining are able to consider those as an investment, and you should be able to get a return on your investment once upon joining. So we're going to show you not 1, but 2 this time, because obviously the market's corrected. So we've got 2 fantastic opportunities coming up for you. So hang around for that. So it's very simple here. Roger's explained the service. 1 report is standard, no account management service. So if you're happy just to go through the reports on your own and not speak to anyone, that's fine. But we still have a customer service team on the main line. $1,095 for 1 year. If you'd like to try us out. Better value, we're offering $1,595 for 2 years, which is only $795 per year. I'll be honest, the stock market goes very quick with age, so you'll be surprised how quick that 1 year goes. So 2 years is better value, and then we're offering a one-off 3 year. And we usually put those longer term memberships, which is what most of our members renew for, because most members have a self-managed super fund or a long-term portfolio. The last thing they want to be doing is paying every 12 months for our service. So you can lock in the plan longer term and save on your annualized costs. So that's for one report, any one report. 2 years, which is generally our most popular membership with our members, unless you want more support throughout the year. $1,545 a year, as Roger explained. We've got a really good offer there for 2 years, which is basically $999 a year at $1,995. Or the better value membership, we're actually offering not 3 but 4 years. So we're quite serious about winning your business today. $2,995 for 4 years, which equates to just $750 a year. And obviously, if you want to put that in a super fund, we can invoice your super fund. Platinum members, $2,590 a year, all reports, including international coverage, including the US, Asia, Europe, and UK. $2,995 for 2 years. If you want to try it out for a year, that's fine, $2,590. But we're offering a better value membership there for 2 years for platinum members. And obviously, if you're a long-term investor and you've got a super fund, $3,995 for 4 years. It's only $1,000 a year. And you can enjoy that service for the next 4 years. And from where the market is at the moment, you should be able to get a return from here. And also, if it's the ideal service, it's something we offer our long-term members and members that want to have portfolio discussions throughout the year. Ask questions on individual stocks. $3,995 for 4 years. That's good value there. It's only $1,000 a year, and we can do an initial portfolio review, and you can also request a portfolio review once a year. On top of that, you can also request portfolio discussions with your account manager. So myself and Roger generally do the portfolio reviews. So we generally look after all of our platinum members, and we also have our customer service team to take some inquiries throughout the year as well. But I generally mainly look after, longer term and platinum members there. So that's the offers there that we're offering today. Good time to join. Again, we're not brokers. We won't manage your money. You're a self-guided investor. You can take advantage of the service as much as you can. And we look forward to welcoming you on board today.
Excellent.
So there's the poll there, Roger, which you can go through.
Yeah, absolutely. So here's a simple registration of interest. So if you're interested in standard, premium, or platinum, you can click on one of those options and we will get back in touch. So I know, John, you asked that question earlier on the rejoining the service. So here you go. If you look at the platinum, that's probably the best one for you. I think that's what it looks like you had in the past. So the 4 years platinum will get you that $1,000 a year, which is not much. And you and I both know that $1,000 a year is a very small amount, as a bit of an insurance policy, if you like, for what you invested in the market. So if you want to give us a go on either or, let us know. If you do have questions which are unanswered, you can tick the fourth option and we will get back in touch, answer those questions, and if you're comfortable after that, we can then work out which package suits you the best. But either or, premium is normally 70% of our members usually join on the premium, and about 20% stick to platinum, which gives them a better value and better service. And finally, about 10% are on standard, just looking at one of the reports. So if you are an Australian investor, premium is the way to go. If you're looking at the best service, the platinum is going to satisfy your needs. So look, I'm just going to close this now, another 5 or 10 seconds. I think a lot of people have shown interest on premium as usual, couple on standards, and I've got about 10% on platinum so far. So another few seconds and we'll lock this up, and then we'll look at two hidden gems. And those of you who will join our service today, you will be given the names of these hidden gems. But I'm just going to close this now and then move on to the first hidden gem. So thank you for your interest. The first hidden gem that we'll be sharing with our members joining us today, this is a financial technology firm, and they've been around since 2001, as you can see here, listed in 2006 on the ASX. They've got offices around the world, and they cover around $200 billion in assets. They do portfolio management, CRM, financial planning, and lots of other financial technology assets. So far, they've had record inflows of $2.9 billion in the last quarter. And you can see the funds under management are going up and up. And currently, they're managing around $49 billion. So it has grown substantially over the last few years. And recently, they made a pretty big announcement where they've sold the international business for $65 million Australian. And they've now received the money, and they're going to pay next month a special dividend of 5 cents per share to the shareholders. This is coming next month. Now, the beauty of this 5 cents per share is this company is currently trading at 57 cents per share. They've been up and down over the last 12 months, 2 years, as high as $1.60. And now trading at around 57 cents. So if you buy them today at 57 cents, you're guaranteed to get a 5 cent dividend next month, which represents around 8.5% yield straight away. So that's quite a healthy little return. So if you join our service today on this stock, that will pay for your service straight away, regardless of which level you join. Now we're expecting this stock to grow, go back up to that $1.50 level. And just to let you know, they received an offer from another big competitor to be bought out at $1.50. And that's what took the share price higher. Now, this company rejected that offer, and they thought that was not in the best interest of shareholders, and it was undervalued. And then the buyer went away. So that's what brought the share price down. At this point in time, we think this is a fantastic opportunity to buy it cheap, get an 8.5%, 9% yield straight away next month, and then wait and watch over the next 6 to 12 months. We're expecting this to go back up to that dollar plus mark, which will give you a nice little growth. So that one stock alone will pay you straight away. The last hidden gem, which we'll also reveal to our members joining today, is a gold explorer. Now over to you, Ed. Just tell us about this one.
Yeah, so we touched on the gold space, the valuation there regarding gold stocks versus the gold price. Relatively underperformed for quite some time at the moment. So this stock is a small cap. They recently acquired a production, so they are a gold producer, and they've just recently expanded. They're about to expand. They've raised some cash. So they currently have a cash holding of around 20 million. Market cap, as you can see, 74 million. Mainly gold, but they do have some copper and silver production as well. They're also exploring as well, so they're going to find more. But the fact is, the placement has now been made by institutional investors, and they've also had a smaller retail offer, which was taken up at around that 5 cent a share price. So there's plenty of value in this stock. Again, they are a producer, they're infrastructure ready, which means their initial production is already up and going, and now they're going to expand on that. So it's a penny stock at the moment, let's face it, it's a micro cap, but it has tremendous upside potential. Even a 50% upside from here would be a great investment. So it's not for everyone. If you don't invest in any small companies, it's probably not for you. But if you're someone that does add a bit of variety and you are risk averse to these stocks, the good thing is as well, it's thinly traded, so it's not a day trader stock. And these are the stocks that we like. So our last hidden gem from June was also thinly traded, and Roger, it was up around what, 50%?
50% in a month.
Ended it. The one prior to that, there was a couple at the start of this year which are also thinly traded. So these are the stocks that we like. We don't like to recommend day trader stocks. I mean, these are the worst stocks to invest in the market. So their charts look like a heart monitor. They're just up one day, down the rest. So this is an incredible opportunity to get in at the lowest price that I've seen this in many, many years. You can see our initial buy price there at 3.6 cents. It's not far off that at the moment. It's had its highs, it's had its lows, but it's now a producer and also an explorer, which means they're going to find more under the ground, and it's a good little micro cap to add a bit of variety to your portfolio. So that's a buy recommendation at the current price.
Excellent. All right, we've just received a couple more comments from David. He says, excellent presentation. Thank you, guys. I've got a lot of clarity on where the markets are going and also some tips. So thank you for that. Welcome, David. We also had Jonathan saying, I'm keen to join the service. I've been thinking about doing something different. And today I'm actually interested in joining. How do we go about this? So, just to let you know, Jonathan, we will get back in touch for those of you who've shown interest in our service, and we will answer any further questions, and then basically set you up on the membership account, and then you're good to go. So we'll get back in touch with you guys later on in the next few hours. Other than that, look, thank you for your company. We hope you got some good information from us today, some market updates and some stock information. If you decided you're going to join our service, we congratulate you for making taking the first step to a change. If you're still thinking about it and you haven't made up your mind, well, perhaps the special offers could give you a bit of motivation. Also ask yourself the question, if in the last few months you could have done something better, if you had some advice on which ones to sell and avoid, maybe that could have paid for the service itself. So there's still time for you to make some changes, and we're here to help. So on that note, I'll pass it on to Edward. My name's Roger. Thanks for your time today, and over to you, Edward.
Yes, thank you, Roger. Great presentation as usual. We're quite thorough. We've showed investors what we do and how we can assist. If you still have questions, info@fatprofits.com.au. You can ask for Roger or myself, and we'll get back to you. Apart from that, hopefully looking to welcome lots of new members on board, and it's a good time to join. You're joining at pretty much the end of a 3-month correction in the markets. So there's definitely plenty of opportunities we can present to you. Have a great day.
Okay, bye-bye.